Hey guys, I wanted to speak to you about closing entries. Just give you a little more clarification on that from the textbook. So, um, I'm looking currently on page 568 of our textbook, and all these closing entries are coming from page 550 of our textbook. So you'll see this work, you'll find this worksheet on page 550. So I'll just write that here. So this is page 550. Okay? All right. So remember that in our closing entries, we have to close down, we have to bring every single revenue and expense account back to zero. All right? Actually, before that, also, just to clarify, this is for the periodic inventory system. Okay? All this is for the periodic inventory system. Great handwriting. Okay. And you know that it's periodic inventory system because you see, well, you don't see a cost of goods sold account. If you saw a cost of goods sold account, then it would be perpetual inventory system. All right? Okay. So we're dealing with periodic inventory system here. And so remember that this was my $90,000. This was my beginning inventory on January 1st. And now we're sitting at December 31st making this worksheet. Okay? Remember that to try to remember the reason we have these two numbers here. Okay? And this will make sense now even better. All right, so let's look at our closing entries. So first, we close down all of our revenue accounts. So here, if you see, where are my revenue accounts? I have in the 400s just sales. This is my only revenue account. So since sales has a credit balance, to empty it out, I will need a debit balance. So sorry, to empty it out, I will need to debit all of sales. Okay, so I go to my closing entries, and there we see that we have debited all my sales. Okay, 320,000. Also, so this will, yeah, okay. So we've debited all our sales. You see that we've also debited our merchandise inventory for the ending inventory. All right. And you'll see in a second why we've done that. But together, for these two amounts, together we have credited our income summary. Okay. The reason we've debited merchandise inventory is because this is the ending inventory. This is what we want left in the merchandise inventory. Merchandise inventory, since it's an asset, it has a debit balance. Okay, it has a debit balance, so we want 86,000 left in here. We don't want 90,000 sitting here. So where does this 90,000 go? It is gonna get credited right here. So we're crediting merchandise inventory for 90,000. This is, so in this sense, this is the first step for merchandise inventory, and this is the second step for merchandise inventory. But this one shows up here first because it shows up with the sales. It really doesn't matter which entry, which entry you do first, whether you do this entry or this entry. After both, the effect will be the same. You just have to remember to empty the merchandise inventory account, you have to credit it, and then to put the $86,000 in, you have to debit it. All right. To empty out your revenue account, you have to debit it because revenue has a credit, regular credit balance. Now, all of these that you see right here, are your expense accounts. Because expense accounts have a regular debit balance, to empty out your expense accounts, you have to credit them. So you see that we're crediting all of our expense accounts. Also, we are crediting purchases. Purchases is also a temporary account, has to be emptied out. This is not an expense account, this is a cost of goods sold account. All right? Because in the income statement, it shows up in your cost of goods sold section. So you see here to close the inventory accounts, the cost of goods sold accounts, and the expense accounts. Okay, so that's those are all the things that get credited and emptied out into income summary. So all these values here get emptied out and put into income summary. All these values get emptied out and put into income summary on the other end. So now you see that my income summary account, I have my income summary account. You see that my income summary was credited 406,000. My income summary was debited 357,000. 425. And so right now your income summary ends up having a credit balance. So if it has a credit balance, you subtract the two, and I'll put the balance right here, which is 68,575. So my balance is 68,575. And then I have, because this is a credit balance, I'm going to empty income summary out and put it all into capital. Because in the end, all of this either is increasing my capital or decreasing my capital. So I'm going to empty this out. I'm going to debit my income summary, 68,575, and credit my capital. So crediting capital is increases capital. If I had, so this means I have a net income. If I had a net loss, your expenses would be greater than your sales, and you will end up having a debit balance in income summary, and then to empty it out, you would have to credit income summary and debit capital, which would decrease capital. But this isn't that case. That would be the opposite case if you have a net loss. All right. So once you've put that in, then you have your drawings. So again, let's go here. I see that my drawings, we know that a drawings has a debit balance. So I have to credit it to empty it out. Therefore, I credit my drawings account, opposite of its regular balance, and empty it into capital. And that's the full $28,000 balance. And those are all my closing entries.